But I think that's a very interesting topic because for two things. One is the dispersion. You mentioned before, and even on a recent podcast we were talking about, and the advisor was telling how the last few years they were killed by the dispersion because only a few stocks really perform well. Everyone else just underperformed, and that's killing them because of the war stocks, but it's just in general, right? Because if you're not long on Nvidia or on the Magnificent Seven, even on Magnificent Seven now, it's only a few. It's probably Magnificent Three.
Yeah.
You know, how do you actually, you know, can use can use diversification when, you know, the diversification goes against you? And second, volatility. I think it's interesting you say, right? Because you're right. Volatility has been very subdued for a few reasons, right? The political and let's say economical or the monetary policies from the different central banks, but also because of the liquidity in this market, in the derivatives market, as well as in financial markets, where actually you have less companies being listed.
Yep.
So it means all the money in financial markets is going to the exact companies. Um, yeah, I don't know.
I think
Yeah,
particularly on the implied volatility, I mean that has been extremely subdued by. If you think about retail or investors, mainly only did underwriting of they were selling puts basically implicitly in the autocallables, and at the same time you have these billion-dollar funds who do call overwriting on single stocks. Yeah, the other side is not really buying that much, optionality. So it's also, I think that has a big impact. Don't understand what happens with the hedging. You know what I mean? If you long the calls as a bank, the minute the market goes up, you have to sell the underlying stock. Boom, you're pushing it down
yeah.
again.
I think it's yeah. I understand your position about volatility, but because of all of this, I also see the opposite is investors taking more risk, and not many risk control, but actually target volatility indices, where instead of having 15-7% volatility on S&P, you have a S&P target vol of 35 or 40%,
Hmm.
and then underwriting put options on those is yeah, the search for yield, especially when rates are coming down, the search for yield. How worried is you? And I'm asking you because you were at City back in the beginning of the 21st
Yeah.
century. Not that I'm calling you old.
Thank you.
I would say
I have
experienced.
gray hair,
Uh,
yes.
well, me too. I started to have some gray hairs. How do you see that? Because you have that experience, right? You have resisted back in a way than before that.
Um, I mean, I don't have the view any much so much on the strategy on what is done in the structured products market, and I call it the traditional one. I can only tell you that across the whole platform, and it's being used by more than 2,000 external asset managers, we don't see much of targeted volatility indices in there. People seem to care more, and it's probably also a reflection of that the AMC can be smaller in AUMs to start with. Often they are set up for a few investors, maybe only for one. So often
Yeah.
more, I would say, ESD or trends or themes are much more the way how the AMC is used is to get access to. Then because it's such a quick product you can implement, you can be up and running in a week or two. If there's a theme that comes up, or then people use it to do it. The volatility target is something often it's a long-term investment. You're gonna hold on to you can stay in it even if volatility goes up. We're gonna handle it. So I see that less in the AMC market or being used for, to be very honest.